Hey, it's Anthony Tucker with Land Title. We came to bring you your big Boulder County market update for the month. Let's dive right into the June data as we're looking backwards and some interesting things happening.
Yes. So first off, let's go ahead and take a look at this. Let's look at our year over year and our average sales price. Up almost 18%. You go, wow, that's amazing. What's going on? Remember, this is an average. We had a fantastic month in luxury sales, and that, really 2 to 3 million, and then that 3 million plus. We just had awesome sales numbers across the board. That really drove up our average sales price. But I think the other key piece of this is looking at our active inventory. We're only slightly growing month over month. And if you remember from last year, we had way too much inventory. This is going to be a very important theme throughout this video, inventory.
It is. Now, let's talk a little bit about inventory in the attached market. We are down about 7.5% from last year. Not nearly as much of a shift as the detached market has felt, but it is helping. But the only other problem is there are 6% less buyers in the attached market than there were even a year ago. And it was hard last year, right? It's just getting more and more difficult. So that is problematic. The average sales price here shows it's flat. I don't think it is, and we're going to get more into that as well. So Tucker, tell us what's going on as far as actual units.
Yes.
Detached.
So let's look at it by our submarkets. Starting off with Boulder County for detached, we have 360 in the market. That is by far, that's about a third of the overall inventory in the county. That's just showing Boulder has the surplus of inventory because, right, we're a little bit more expensive typically. But as we're looking across the submarkets, look at the year over year numbers. We're down giant double digit numbers. 18, 28, 23, 49, 45%. And this is what's keeping the price stability really across the board for our median average, and plus or minus average and median priced homes. This is really keeping our price stability, is this lack of inventory. So while, yes, it sucks for the buyers out there, it's also keeping our listings and our real estate holding steady, which is just further proving why Boulder is such a safe investment in the detached market.
As far as attached goes, well, it might not be quite of a safe investment because there are 280 units just in the city of Boulder on the market. That represents more than half of all the county's attached units. So what's really happening in Boulder is it's saturated. There's not enough buyers, right? And we're seeing that. Now, that doesn't change the fact that luxury and attached has done okay this year, but that's just such a small portion of attached, right? And so the other part of the market is, think about Longmont. Longmont and Boulder are very similar in size. There's only 100 units in Longmont compared to the 280 in Boulder. That is also trending down. Longmont's much more stable market in the attached dwellings, but then you get out to a few other places. Look at Lafayette, only 30 units on the market, 36% less than last year. We are just every little market is so different right now, but attached is struggling, detached is the gold standard. And I think that's just the easiest takeaway.
And then the in-between would be your attached that lives like detached. You have a backyard and unit townhouse.
Right. And that is actually in this data.
And that's in here, but that's really important to remember is those are a little bit in between.
Yeah, like Lafayette. It's a great example of what's attached out there.
So looking at our month supply of inventory, right, we're sitting at 3.5 months for the county. That's a pretty balanced number right now, given where we're at in Boulder County and across the Front Range. But when we look at our submarkets, it's vastly different. Look at Niwot at 6.5. Why is that? Because it's a high-end small market. Look at Boulder at 4 and 3/4 pretty much, 4.25, 4 3/4. Right, much higher than the average. Why? It's more expensive. We have more inventory.
Right, all price driven.
So it's all price driven. Then when we get to Longmont, we kind of see, hey, it's a little bit faster market. It's under our county median, and we're running at 3 months. It's a little bit faster. But when we get to Lafayette, Louisville, Superior, and even Erie, they are under 3 months, and they're running extremely fast. And so it's showing how when buyers are out in those markets shopping, they got to be really quick to make a decision. And sellers hold more of the cards. They have more negotiating power. They don't have to give up as many concessions. So we can see how different it is even within the county, especially looking at Superior. They're under 2 months supply of inventory and detached.
Who would have ever thought it was the fastest market, right?
Well, they finally got through the Marshall fires. Look at that. They got a bunch of nice new inventory.
Speaking of fastest markets, now let's talk slowest markets. Superior being the slowest market in the attached market. So we're basically sitting at 10 months of inventory there. That's pretty brutal, right? 10 months is just too much. You see this in some of the mountain markets as well. It's kind of brutal. Niwot clearly has more attached inventory as well, but there's really not very many of them. I think the one to really point out here is Boulder's kind of the anomaly, right? Boulder is more expensive, so it's going to take longer to sell. We have 6 months of inventory minimum. in most of our buildings, and the condos are going to act really different than the townhouses. But 6 months is a lot, right? And that is truly a buyer's market in so many ways. You get into the L towns in Erie, we're still at 4.5 months. It's just not pretty, right? The problem is most of the time you can go buy a detached single family home somewhere out in the county for the same monthly payment as the condo townhouses. And that's just brutal. It's just not what most people are going to do. So they actually have just gravitated towards detached.
So kind of switching gears here, looking at our days in MLS. So for the county right now, we're sitting at 35 days in the MLS. When we're looking into our submarkets, what's the highest? Superior is the highest in there for detached, which is kind of counterintuitive given that it's the lowest month supply of inventory. What does that mean? Things that were sitting sold, right? That's why we have that high number. Some things that have been on the market a while sold when I was looking into it. But as we look across the other parts of the county, look at places like Longmont. They sell faster. It's a faster moving market. Erie, not as fast. It's a little bit slower. It's closer to Boulder. It's above the average. So Erie, you're going to have a little bit more time with buyers, sellers. It's going to take a little bit longer. And then really looking at, I really like to look at that Louisville and Lafayette. They're still doing quite well in that range, and especially Lafayette, because of that price point, has really picked up a lot of steam. So the days in MLS is kind of all over the board because some things are sitting, some are going quick. I think it's more important to look at each, look at your neighborhood and look at your listing and know if we're overpriced, we're going to sit.
Absolutely. You can see it in the attached market too. Even though the attached market is almost double the time on market, you really see it in certain markets. I mean, Niwot's a good example. The one that sold last month sold in 6 days. But also you see it out in Lafayette, 27 days in MLS, right? A good product is going to trade because people are paying attention. So townhouses in Lafayette live so much like single family, people are kind of gravitating that way. So that's a good sign. But the real hard part is you got a place like Boulder or Erie, 86 days in Erie, 71 days in Boulder. It's just taking longer to sell. And those are the good units that are selling. So how many of them aren't selling, right? Mm-hmm. So this is a tough one.
So this is a really exciting slide. So let's go ahead and start on the red. Let's take a look here. This is a huge month in the $3+ million market. A lot of sales, really strong, one of the strongest months we've had in years. Anthony and I were chatting a little bit before this. We kind of think it's a little bit of financial turmoil. People are moving their money into real estate potentially. And then 2, Sundance effect is starting to hit. I think we're really finally starting to hit a little bit of this first touch of the Sundance effect. And where else we saw really, really strong sales was that 1.5 to 2 million, and then that 2 to 2.5 million. Some of the best months we've ever seen, in a long time. 75% over last year, about 40% over last month.
Well, like
really good.
55% more sales from 2 to 2.5 million than we had all year last year to date.
Yeah.
So really cool stuff is happening in luxury. I am a little concerned with the median area or like the lower end stuff in the county, just a little bit slower than I would expect. Mm-hmm. So kind of is what it is though.
Yeah, but it is a good sign that even in our meat and potatoes, we still have increasing sales as we would expect coming into from May into June. But on our inventory side, we can see we're still growing, but it's not equal where we're growing in our inventory. Right. And I'd like to focus on that because if you're looking at our county, hey, that 800 to a million is actually growing pretty nice month over month. We've added a good amount of inventory. That 600, 800, we added a good amount of inventory. Where we haven't is that 1 to 2 million, we pretty much stayed flat in inventory. So that means it's going to be compressing more and it's going to be more competitive in that market if we don't start getting more inventory on the board.
Okay, the attached side of things, let's focus on the solds first. I think it's really important to look at the hardest part of this market. 800 to a million is really struggling. Year to date, they're down 55% in sales. Again, another really tough month. We had 7 sales. That's better than you can say for a lot of this year so far, but that part is hard, right? You get into the lower stuff. Craziest thing I've seen in a long time. I actually fought to get rid of the 0 to 299 in this county for a long time, and all of a sudden we need it. So who would have thought prices had come down and attached enough where you needed a good price band for under 300,000. 12 sold though, which is actually better than you can say for a lot of months up to this point. So that's a good sign. Now, as far as active units of inventory are concerned, they've been piling up in a couple of places. Under 400,000, lots more inventory than we had last year, and just a little bit more in luxury in some places. But other than that, it seems like frustrated sellers are pulling things off the market, getting them rented, maybe trying again later, or they're just being patient enough that maybe they get it sold over time. So Definitely some interesting news in attached, but so different than detached.
Yeah. Now, this is one of my favorite slides because it really shows on the left-hand side here with our month supply of inventory how competitive it is by price band across the county. And I love looking at this because it shows that, yes, while for the majority of the county we've actually increased month over month, we're still down a ton year over year. It's a much better market for sellers than it was last year because we don't have the overall stacking up of inventory. So this is a really good sign for the seller. For the buyer, it's a little bit more stable, right? So when we're looking at this, you can see how competitive it's gone all the way up to that $1.5 million range across the county, all under 3 months supply of inventory, which is 3.5 is our average for last month. So all well underneath that average. Once we get to that 1.5 million, that's when we really start seeing it become more and more favored towards the buyer, especially when we get up to that $3 million range, right? 23 months supply of inventory. That's 2 years.
A lot of stuff.
A lot of stuff up there. We're going to see a little bit, hopefully, more of that Sundance effect. Knock chunks of that down.
We sure hope so. Look at the attached side of it, exactly the opposite. We've talked about this before, but basically start at 5 months of inventory, it's a buyer's market. You get up to 6 or 7 months of inventory in a lot of these price ranges. So you really have to be the best unit on the market if you're selling something. And if you're a buyer, don't be afraid to go in and negotiate, because if you want to get something under contract, there's a lot of sellers that would like to wiggle. They just,
sometimes they don't want to do a price drop because they think that's final. Write an offer, right? That's why it's a negotiation tool. Write an offer.
Absolutely. And then
Tucker and I did title guys, though.
Yeah, right. Well, we did want to talk to you a little bit about average sales price. We have one good tool that will help you kind of break through some of the noise, right? This trailing 12-month percentage change number really is your metric when you're looking at like long-term appreciation. So what's actually happened in the city of Boulder in the detached single-family home market? Clearly, it's not 18% up, right? One good month means a lot of luxury sold. We're actually sitting somewhere around a minus 6% number for the last 12 months. Now, that's very different than a lot of the submarkets, right? But it's because we've seen a lot of downward momentum in the luxury market.
Mm-hmm.
And yes, a lot of it's selling, and that's fine. But what we're really seeing is a slow contraction in the marketplace. Now, Lafayette's down 1.8%, Longmont's down 2%, a place like Erie, though, up 4%. Now, skewed a little bit by new builds, stuff like that. But Louisville and Superior is still feeling some of that Marshall Fire effect that's causing prices to be a little bit higher. What about attached?
So attached, the numbers are what the numbers are. But really, for Boulder County and as a whole, we've slid in that TTM that's trailing 12 months about 5% as a county. The 7% in Boulder seems about right. Louisville, all these counties feel about right. Remember, Superior has all that brand new attached downtown, so that's what's skewing their prices higher. It's because that's a much different product than what we're selling in Boulder and Longmont.
Yeah.
So it's a much different price, but right, we are coming down in prices. We haven't found the bottom yet, but I got some news to share towards the last slide.
All right, so let's talk a little about sold units. This is a snapshot, right? If you got to send something to somebody, talk about the strength of the market or what's happening, you can see year to date 1.4% more sales than we had a year ago. That sounds great, right? And you can see where the sales are taking place. 10% up in Lafayette, 10% down in Superior, right? It's very easy to digest. Always like to have this as a tool for you. And then the attached one.
Same thing for attached, just, we're down in sales pretty much.
Pretty
compared
easy to show
to
there.
Year to date. Now, this is where I really wanted to chat. Excuse me, you do detached, I'll do attached.
Okay, well, list sale price for the detached market is pretty stable. It's been nice to see a little more seasonality this year than before. It has been exciting to see that, buyers had to come out and actually participate and be at the negotiating table. It's like the last couple of years is just how much concessions can I get? And then it doesn't even show up in this chart. So 98.2% this month, not bad. Definitely less than it was a couple of months ago or last month. We definitely hit the peak in May. We usually do. So nothing to be concerned about, but good news, it's stable, right? This is very similar to what you'd expect.
So what's interesting here is in the attached market, you would think with how all the numbers we just talked about are showing how buyer favorite it is, but it's still showing that it's around that 97, 98% across the board, across almost all the price bands. Why is that? Well, it's because of the concessions, and people are waiting for the price drops before they put in the offers from what we can tell, right? Because when we see numbers this close to the list price, this isn't the initial list price. This is the list price in the MLS the day it went under contract. So this is just showing once the house has been reduced to that right price, you will start getting more offers that are going to be in that ballpark. Folks aren't writing a 15% less offer on that initial opening weekend, even if it is overpriced. They're not even looking at it. So it's so important. I just want to show this because it's so important to remember where pricing is for your listings. Then also from the buyer's perspective, go write an offer, right? Don't wait for all those price drops. Go write an offer on what you think the value is, and you might get the deal you need.
Absolutely. Well, thanks for joining us today. Of course, we're here to help you with any of your other data needs. We're Anthony and Tucker, Fly and Title. Don't forget to like and subscribe to the YouTube channel, and catch you next time.
Cheers, everybody.